So let's talk about put options. I know, the name itself can sound a little intimidating, right? But what if I told you the main idea is something you probably already understand? Something you might even deal with every single year. We're going to break this whole thing down by connecting it to a concept you already know.
Okay, just think about this for a second. When you have something really valuable, like your car, how do you protect it from a worst-case scenario? You get insurance, right? It's that simple. Just hold on to that very simple, very powerful idea. All right, you've got that idea locked in? Good. Now let's just swap out the car for something else. What about your financial assets, like your stocks? They can also lose value, and sometimes they can lose a lot of value. So, is there a way to insure them against a big price drop? Well, the answer is absolutely yes.
So let's really dig into this by building from the ground up, using that car insurance analogy. Seriously, by understanding the simple parts of your auto policy, you're going to see that you've basically got the fundamentals of options down already.
Okay, so picture this. You've got a beautiful car. It's worth $100,000. It's a huge asset, right? And the last thing you want is for it to get wrecked in an accident and lose all that value. So what do? Well, you go to an insurance company and you pay them a fee for a policy. We call that fee the premium. In our example, let's just say it's $3,000 for a year of coverage. That's the price you pay for peace of mind. And what do you get for that $3,000? You get coverage. Now, the insurance company is the one on the hook. They're promising to cover any damages, maybe even up to the car's full value of $100,000. And let's say the worst happens. Bam, you get into an accident. Maybe there's $20,000 in damage. You file a claim, and guess what? The insurance company pays it. You just spent a relatively small fee to avoid a massive financial hit. It's a simple but really powerful concept.
Okay, so we've got the insurance model down pat, right? The owner, the insurer, the premium, the claim, we get it. Now for the fun part. Let's take that exact structure and just drop it right into the world of finance.
In this slide, this is where it all clicks. Look at this. It's practically a direct translation. Your car, that's now what we call an underlying asset, like a stock. The insurance company, they're the option writer. The premium is still a premium. And the damage you're insuring against is simply a drop in the asset's price. It's the exact same framework, just with new labels. All right, so now we're ready to actually decode the key terminology. But as we go through each of these new words, just keep that car insurance comparison front and center in your mind. It is the secret key that unlocks everything here. So, first up, the put option itself. What is it? It's a contract, and it gives the person who owns it the right, and this is super important, not the obligation, to sell an asset at a price you both agreed on beforehand. It's basically your right to file that insurance claim if you need it. And the underlying asset, that's just a fancy term for the thing you're insuring. So instead of your car, it could be shares in some tech company, or an entire stock market index, or even a commodity like oil. It's just whatever you're trying to protect from a fall in value. So, who's selling you this financial insurance? That's the option writer. You can think of them as the insurance company in this whole scenario. They're the ones who collect your premium, and in exchange, they take on the risk that the price might go down. The option premium, well, that's just the price tag on the contract. It's your insurance payment. And just like with car insurance, the cost depends on the risk. So if the asset is super volatile or you want protection for a really long time, you guessed it, the premium is going to be higher.
Okay, so you've paid your premium. You've got your financial protection all set up. Now what? What can actually happen? Well, for you, the person who bought the put option, it really just boils down to two simple outcomes. So think of this as two paths you can go down. On the left, the accident happens. The asset's price drops. Your insurance totally pays off. Your option is now valuable because it gives you the right to sell at a price that's way better than the current market price. And the more the price falls, the more valuable your insurance policy gets. Now look at the right side. This is the no accident scenario. The price stays the same, or maybe it even goes up. In that case, you just didn't need the insurance. The option simply expires, and the only thing you're out is the premium you paid. That's it. And this right here, this is probably the single most important thing to remember if you're the buyer. Your risk is completely defined the second you buy that option. The absolute most you can ever lose is the premium you paid. Full stop. Your downside is capped. It doesn't matter what happens in the market. Okay, let's wrap this all up and get to the key takeaway. What have we really learned here about the price of protection? At the end of the day, it's this simple. A put option is just like buying insurance, but for a financial asset. Its whole job is to protect you against a price drop. You, the option buyer, pay a premium for that protection. And the option writer? They're the insurance company collecting that premium. And the best part? For the buyer, your potential loss is always capped at what you paid for that premium. When you look at it that way, all that complexity just kind of melts away, doesn't it? Which really brings us right back to that fundamental question. Whether we're talking about your car or your stock portfolio, the choice is always the same, isn't it? Is paying a small, known price for protection worth it to you? That's really the heart of what a put option is all about. Hey everyone, and welcome. Today, we're going to jump right into stock options. And trust me, by the end of this, you'll have a rock-solid understanding of the two most important parts of a put option, the strike price and the expiration date. So, picture this. You own stock in a company you really believe in, but you've got that nagging feeling, that nervousness that the market could take a nosedive. How do you protect yourself? It's a question every single investor asks, and believe it or not, a put option is a really powerful answer. All right, here's our game plan. We're going to break this down into 4 simple parts. First, we'll talk about why options are basically like insurance for your stocks. Then, we'll get into the payout, that's the strike price. After that, we'll talk about the ticking clock, which is the expiration date. And finally, we'll put it all together to see how the price of this protection is actually figured out. Okay, so let's start with the big idea. Let's just forget all the complicated Wall Street jargon for a minute. At its heart, you should think of a put option as a simple solution to that problem we just talked about, protecting your hard-earned investment. Now, okay, that's the textbook definition. A bit dry, right? But what does it really mean for you? Well, the easiest way to think about it is as an insurance policy for your stock. You're paying a small fee, that's called a premium, to protect yourself if the price drops. It gives you the right to sell, but here's the key. You're not forced to. You're in control. To make this all super clear, we're going to stick with one example the whole way through. Let's imagine you own shares of Teva, and right now the stock is trading at exactly $20 a share. Just keep that $20 number in your head as we go. So if a put option is our insurance policy, the next logical question is, what actually makes it pay out? And that brings us to our first really key term, the strike price. The strike price is basically the price you get to lock in. It's the price you have the right to sell your Teva stock for, and it doesn't matter how low the actual market price might fall. In our insurance analogy, this is the exact value you're insuring your stock for. And this is where the strategy really starts to come in. So you can choose from a whole bunch of different strike prices, and your choice directly impacts how much that insurance policy is going to cost you. So how does that work? Let's just walk through this table. Remember, our stock is at $20. Now, if you pick a $25 strike price, you're getting the right to sell your stock for $5 more than it's worth right now. That's a great deal, right? It's called being in the money. And because it has immediate built-in value, it's the most expensive option here. Let's say $7. A $22 strike is also in the money, but a little less so the cost comes down to maybe $2.80. But now what if you choose an $18 strike? Well, that's out of the money. That means the stock actually has to fall before your protection even starts. And because that protection isn't a sure thing, the cost is way, way lower, maybe just 60 cents. The bottom line is simple. The more valuable the protection you want, the more you're going to pay for it. Okay, awesome. So we've set our payout level with the strike price. But, and this is a big but, just like your car insurance, this protection doesn't last forever. That brings us to our second key component, the expiration date. Yep, it's pretty much exactly what it sounds like. This is the final day your contract is valid. If you haven't used your right to sell your stock by this date, the option just, well, it expires. It vanishes and your coverage is over. And the trade-off here is really simple to grasp. An option that expires in a year gives the stock way more time to potentially drop than one that expires in just 2 months. More time means more uncertainty and a higher chance of something happening, which makes that long-term protection more valuable and, you guessed it, more expensive. All right, let's tie this all together now. We've looked at the payout trigger, that's our strike price, and we've looked at the time limit, the expiration date. These two things are really the main drivers behind how much an option is going to cost. And this all boils down to two golden rules of pricing put options. Rule number one, the higher your strike price is, the more that option is going to cost. You're simply paying for better protection. And rule number two, the farther out the expiration date is, the more that option is going to cost. You're paying for more time on the clock.
So ultimately, it's all just a balancing act. Choosing a put option is about finding that sweet spot, the right mix of coverage and cost that works for your personal strategy. You're constantly weighing how much protection you think you need versus how long you think you'll need it. So the question I'll leave you with is this. When you think about your own investments, where do you draw that line? What's the right balance for you between the cost of that protection and the amount of risk you're willing to handle? That right there is the strategic decision every single investor has to make. Thanks for joining us.
All right, today we're going to tackle one of the most important, if not the most important numbers in options trading, the strike price. So let's break it all down, shall we?
Let me ask you a question. You insure your car against an accident, right? Of course you do. Well, what if I told you that you could do basically the same thing for your stock investments? Because that's pretty much what a put option is. It acts just like an insurance policy, protecting you financially if a stock you own starts to take a nosedive. It's an incredibly powerful way to manage your risk.
Okay, so just like with any insurance, you have to choose your level of coverage. And in the world of options, that coverage, it's all defined by one single critical number. And that, my friends, is the strike price.
So what is it? The strike price is the pre-agreed price where you get to exercise your option. Really, think of it as the trigger point. It's the exact stock price where your insurance kicks in and starts to do its job.
Theory is great, but let's make this real. Let's walk through an example. We'll use a hypothetical scenario with Teva stock to see how this actually works.
Okay, so picture this. Teva stock is trading right now on the market for exactly $20 a share. You own some, but you're getting a little nervous that the price might drop soon, so you want to protect your investment.
You decide to buy a put option, your insurance policy. But now you have a choice to make. At what price do you want that protection to start? Where are you going to set that trigger?
So here are your two main choices on the table. On one hand, you can pick a strike price of $19. Now, this gives you really high protection since it's super close to the current price, but that insurance premium is going to cost you $1 per share. Or you could set the strike price way down at $15. This is a lot cheaper, only 50 cents, but the stock has to fall a whole lot further before your protection actually kicks in. And this just lays out that fundamental trade-off perfectly. See, choosing that $19 strike means your protection starts almost immediately if the stock even just dips a little. But that security, well, it comes at a higher price. The $15 strike gives you less immediate protection, but it costs you half as much. So you might be asking yourself, why is one option so much more expensive than the other? Well, the logic behind the pricing is actually pretty intuitive when you think about it. It all comes down to one thing, probability. The price of the option, which by the way is called the premium, is directly tied to how likely it is that the stock will actually hit that strike price. Just think about it. What's more likely? That a $20 stock will drop $1 to 19, or that it'll plummet all the way down to 15? The smaller drop is way more probable, right? So because a huge drop to $15 is less likely, the insurance against it is cheaper. And that's exactly why that option only costs 50 cents. Now here's where things get really fascinating. What if you chose a strike price that's actually above the current stock price? Let's say you pick a strike of $24 for our $20 Teva stock. Can you even do that? Oh yeah, absolutely. But an option like this would be a lot more expensive. And why is that? Well, because the stock at $20 is already below the $24 strike price. Your insurance is already in effect. It has what we call built-in or intrinsic value. You're basically buying an insurance policy that's already paying out. And yeah, that's going to cost you a whole lot more.
So what's the final takeaway here? Choosing a strike price is always a strategic decision. It's this calculated balance between the security you want and the cost you're willing to pay for it.
So let's do a super quick recap. Remember, the strike price is your chosen level of protection. It's the trigger for your insurance. If the strike is closer to the current price, you get more protection, but it's more expensive. If it's further away, it's cheaper, but you have less protection. It really all boils down to that classic trade-off, security versus cost.
And that really leaves us with a final question for you to think about. This isn't just about numbers on a screen. It's about your personal strategy and your comfort level with risk. So when it comes to protecting your investments, what price are you willing to pay for peace of mind?
Hey everyone, and welcome. Have you ever wondered how traders bet against a stock, but without taking on some kind of crazy unlimited risk? Well, today we're going to break down a really popular strategy for doing exactly that. We'll start with the basics of what a put option even is, and then we'll build our way up to a clever technique called the bear put spread. Let's jump right in. Okay, so here's our roadmap. We're going to start with a concept we all get, insurance, to really understand what a put option is all about. From there, we'll actually build the bear put spread, we'll run the numbers on profit and loss, and you'll see exactly how it puts a hard limit on your risk. You know, to really wrap our heads around how a financial option works, we don't need to stare at complex charts and formulas. Not at first. Let's actually start with something we're all familiar with, good old insurance. So how in the world is some complex financial instrument like an option anything like your car insurance policy? Well, it turns out the core idea is exactly the same. It's all about protecting the value of something you own, an asset.
All right, so first things first, you need an asset. In the financial world, that might be a stock, right? But for our example, let's just say it's your car. This is the valuable thing that you want to protect.
Let's put a number on it. Let's say your car is worth a cool $100,000. Naturally, you'd want to protect that value. To do that, you pay a relatively small fee, right? The insurance premium? Let's call it $5,000. Now that payment buys you a really powerful guarantee. It buys you the right to be protected if your car's value plummets. So, if the worst-case scenario happens, your car gets totaled, its value drops to zero, the insurance company steps in and pays you the full $100,000. That premium you paid protected you from a catastrophic loss. And believe it or not, this exact same logic applies to a put option.
All right, so let's take that insurance idea and bring it over to the stock market. This is where we officially meet the put option.
So, a put option buyer is basically the car owner in our story. They pay a fee, it's called a premium, and in exchange, they get the right but not the obligation to sell an asset, like a stock, at a price they agree on beforehand. Now, why would they do this? Because they believe the actual market price of that stock is about to fall. It's literally financial insurance against a price drop.
And for every single option, there are two sides to the coin. And this table just lays out that fundamental conflict perfectly. On one side, you've got the put buyer, our car owner. They pay a premium because they think the price is going down. The most they can lose is that premium they paid. But on the other side, you've got the put writer. They're acting like the insurance company. They collect the premium, and they're betting the price will actually go up or at least stay the same. Their profit is capped, but their potential loss if they're wrong, well, it's huge.
So, you might be thinking, okay, I get it. Buying a put is like buying insurance. Why would I do anything more complicated? And the answer really comes down to two things, cost and precision. To cut down on the premium they have to pay and to really nail down their risk, traders use something called spreads. Let's look at a classic, the bear put spread. Okay, let's make this real. Imagine an investor is bearish on a stock called Box. That's just trader speak for saying they expect the price to fall. More specifically, they think it's going to drop below $20, but they probably don't see it completely collapsing much further than, say, $14. This very specific view is absolutely perfect for a spread strategy.
Now, to pull this off, the investor actually makes two trades at the exact same time. So let's break down how that works, and most importantly, let's calculate the total cost to get into this position in the first place.
This is the whole shebang right here. It's a two-part play. First, they buy the put option with a $20 strike price. That's their insurance policy that pays off if the stock drops below that $20 mark. But to help pay for that insurance, they simultaneously sell the $14 strike put. Now, this move brings in some cash, but it also means they have an obligation if the stock drops all the way below 14. All right, let's follow the money. First up, the cost. They bought 8 of those $20 puts, and the premium was $6 each. So, 8 times 6, That's $48 going out the door.
But remember, at the exact same moment, they're bringing cash in. They sold 8 of the $14 puts and collected a $3 premium on each one, just like an insurance company. So that's $24 coming back into their account. So what's the bottom line? They paid out $48, but they took in $24. The net cost to put this entire strategy on is just $24. And here is the absolute key. That $24 isn't just the cost. It is the absolute maximum amount of money they can possibly lose on this trade, locked in right from the very start.
Okay, the trade is on. We've spent our $24. Now, let's hit the fast forward button to the day these options expire and see how this whole strategy actually plays out at 3 different potential stock prices for Box. This table tells the whole story. Let's start at the top. If the stock finishes way up at $26, well, our bearish bet was wrong. Both options expire completely worthless. We're out our initial $24 cost, and that's it. That's our maximum loss. Now look at that middle row. What if the stock lands at $16? Hey, our plan is working. The puts we bought are now in the money, making us a profit big enough to cover our initial cost and leave us with a nice little $8 gain. But what happens in a crash? What if the stock plummets to $6? This is where the spreads design is so brilliant. Sure, the puts we bought are now wildly profitable, but that profit is offset by the loss from the puts we sold. So the final result, after you factor in our cost, is a $24 profit, our maximum possible gain. So after walking through all those numbers and all those scenarios, what is the single most important thing to take away from a strategy like this one? It all boils down to this: a perfectly defined profile. From the second they put on this trade, the investor knew, with 100% certainty, their absolute best case scenario was a $24 profit, and their absolute worst case was a $24 loss. That is what a hedged strategy is all about. You give up that lottery ticket dream of unlimited profit in exchange for the certainty of a strictly limited risk. And that really leaves us with this central question, the one every trader has to answer for themselves when they look at a spread like this. Is that trade-off, giving up the chance for a massive home run in exchange for the comfort of knowing your exact maximum loss from day one, is that worth it? Your answer to that question really defines your entire approach to the markets. All right, welcome to The Explainer. Today, we're going to break down a really interesting options trade, one that honestly looks like a total contradiction at first glance. We're going to figure out what the strategy was all about, so let's just jump right in. So we're looking at a real trade someone made on Teva stock, and right off the bat, it's a head-scratcher. This person bought options, betting the stock would go up, but then they turned around and sold even more options, betting it would go down. I mean, what's going on there? Why on earth would you do that? Okay, let's get into the nitty-gritty. Here's exactly what they did. They bought 5 call options with a $12 strike price. That part's simple, right? They're hoping the stock goes above $12. But at the exact same time, they wrote, which is just a fancy word for sold, 10 call options with a higher $15 strike price. That's a bet that the stock will actually stay below 15. See? It's a puzzle. So to figure out what this investor was thinking, we've got to go back to basics for a second. We need to really understand the two sides of this coin, buying a call versus writing one. And this, right here, is the heart of the conflict. When you buy a call, you're an optimist. It's a straight-up bet that the stock is going to the moon, and hey, your potential profit is technically unlimited. But when you write a call, you're doing the complete opposite. You're getting paid a little bit of money up front, the premium, and you're basically betting that the stock price is going to sit still, maybe even go down, because if you're wrong and that stock takes off, your potential losses are, well, they're also unlimited. Okay, so we've got the theory down. Now let's follow the money. How much did it actually cost this person to put on this weird, complicated trade? First up, the money going out. They bought 5 call option contracts. Now, just to keep things simple, we're going to talk about everything on a per-share basis. So, at $1 per share, that's $5 out the door to buy those calls. But remember, that's only half the story. They immediately got some cash in by selling or writing those 10 other call contracts. At 40 cents a pop, that brought $4 straight into their account. So you can see it's already offsetting most of what they spent. So you do the math, $5 out, $4 in, and the grand total, the net cost to get into this entire position was just a single dollar. And you got to understand, this super low cost is the whole reason anyone would even consider a strategy like this. This really gets to the core of what the investor was thinking. They weren't just bullish, it was a much more specific bet. They were saying, yeah, I think Teva is going to rise, but I think it's going to run out of steam right around that $15 mark. So what's the dream scenario here? The absolute best thing that can happen is if the stock price lands exactly at $15 when the options expire. Let's walk through why. The 5 calls they bought with a $12 strike? Well, they're now in the money by $3 each. That's a $15 gain right there. And the 10 calls they sold at the $15 strike, they expire completely worthless, so they don't cost a thing. Perfect.
So you take that $15 gain, subtract the $1 it costs to get in, and the max profit is $14. Now think about that. A $14 profit on a $1 investment. That's a 1,400% return. I mean, on paper, that sounds absolutely incredible, right?
And yeah, a 1,400% return sounds amazing. But, and this is a huge but, what about the risk? This is where this whole strategy starts to get really, really dangerous.
Before we go further, let's quickly define a super important term, a hedged strategy. All it means really is that your risk is capped, from the very beginning, the absolute most money you could possibly lose on the trade. There are no nasty surprises.
And this is where the wheels come off our trade. There's a really critical rule of thumb in options trading, which is that a strategy is only truly hedged if the number of options you write is less than or equal to the number of options you buy. Well, our investor wrote 10 calls and only bought 5. They broke the rule. This position is unhedged, and that means the potential for loss is, you guessed it, unlimited.
So let's stress test this thing. What happens if the investor's dead wrong? What if the stock doesn't stall at $15, but instead it just keeps on climbing? Okay, let's say the stock goes nuts and hits $50 a share. The 5 calls they bought, they do great. That's a $190 profit. But remember this 10 calls they sold? That becomes a massive $350 liability. So what's the final score? A shocking $161 loss, all from a $1 bet. The thing that was supposed to make the money completely backfired.
And the scariest part about an unhedged strategy like this, the pain doesn't stop. As the price keeps rising, the losses just get bigger and bigger. They accelerate.
Let's push it even higher. Say the stock goes to $80 a share. Now the loss almost doubles to $311. The higher that stock price climbs, the deeper the hole gets for this investor, and there is absolutely no limit to how much they can lose.
So now that we've seen the potential and pretty tiny profit and the absolutely terrifying risk, we can finally put the last piece of the puzzle together and understand why someone would do this.
Okay, so here's the real reason for the trade. The goal wasn't really about the stock stopping perfectly at $15. That was just the best-case scenario. The investors simply wanted to make a bullish bet by buying calls, but they didn't want to pay full price. So they used the money they got from selling the other calls to finance the whole thing. It was just a way to turn a $5 bet into a $1 bet.
There's an exact price where this trade goes from making a little bit of money to losing a lot of money. This formula here basically represents that tipping point. It's the moment where the gains from the calls they bought get completely canceled out by the losses from the calls they sold, plus that initial $1 cost. And when you solve for X in that equation, you get the break-even price, $17.80. If Teva stock closes just 1 penny above that price when the options expire, this whole thing becomes a losing trade.
So when you boil it all down, what have we learned? This strategy is, at its core, a big trade-off. Yes, it's a super cheap way to bet on a stock going up, but only a little bit. That discount comes with a huge catch. Your profit is capped, and you're exposed to massive, unlimited risk if you're wrong. You're trading safety for a lower entry price.
And that really brings us to the question that's at the heart of so many trading strategies, right? Is it really worth it? Is dramatically lowering your cost of entry worth taking on the risk of a truly unlimited loss?